CPI numbers came out yesterday, and it shocked many across the world, investors, economists alike. Steve Hanke, professor of applied economics at Johns Hopkins University, is back with us to discuss the implications. Steve, welcome back. 4.2% headline inflation. This is the largest number we've seen since 2008. Now, you wrote an article on the Official Monetary and Financial Institutions Forum website just today, and you've talked about this very topic. I'm just going to show the headline of this article. You said inflation surge is harbinger of what's to come. And you said Wednesday's headline inflation shocked many. You're not wrong. It did shock many. So we'll get into what you wrote here. First of all, your headline, harbinger of what's to come. What's to come, Steve?
More inflation.
Yeah.
This number, we 2 months ago, we were at 2.6% annual inflation in the United States. And then this month, we were at 4.2%. And it will go up higher than that. And I think by the end of next year, we'll be up over 5% on a sustained basis. The key here, David, is, as Milton Friedman said in 1966, inflation is always and everywhere a monetary phenomena. And what he meant by that is that if you goose the money supply and get it up too high, you're going to end up with inflation, and money dominates. Now, that's contrary, by the way, to something that Chairman Powell said in testimony in February 23rd. Jerome Powell, a chairman of the Fed, said that we're going to have to unlearn what Milton Friedman told us, that inflation is always and everywhere a monetary phenomenon. This is incredible. A chairman of a central bank saying we're going to have to unlearn monetarism and monetary theory. This is really quite a remarkable statement. Well, it didn't take very long. That was February 23rd, and boom, we're hitting the inflation picture big time, and that's what everybody's worried about in the United States.
Yeah. You said it could rise up to 5%. That doesn't seem very high compared to some other countries around the world. We talked about this in an interview yesterday. We talked about hyperinflationary scenarios in Lebanon and Turkey and whatnot. But 5% is still higher than what we've seen in many, many years, Professor, isn't it?
It's higher than what we've seen for many years, and it's a jump. If you're going from 0 to 5, that's a big jump. And people are not used to that in the United States, and I think there'll be a blowback. And ultimately, this could spell the end of President Biden's triumphal march, this inflation thing. And by the way, to give you some idea of how fast the money supply is growing, if you measure it broadly, as they do at the Center for Financial Stability in New York, you've got M4, Divisia M4, and that's growing at 24% per year. My calculation for the golden growth rate for the money supply, what it should be if you were trying to hit the 2% target that the Fed has for inflation, that golden growth rate's around 6.3%, 6.5%, and it's growing at 24%. So there's a huge gap between the golden growth rate and where we're actually at. And that's why I can say confidently that we will see more inflation on a sustained basis going forward.
You wrote about the golden growth rate of money supply in this article. I've highlighted that paragraph here. I'll just leave that up there while we discuss this. More broadly, Professor, can you define the golden growth rate? What is that? Before you get into the specific number of what it should be, what is it? Yeah.
Okay, what you do, you have to take the quantity theory of money and the equation of exchange. And once you do that, the golden growth rate is simply equal to the inflation target that the central bank has. That's 2%, plus the average real rate of growth in the economy over a given period of time. And the time period that we have up on the board there is the last 10 years that I used in the calculation. And the real GDP growth was 1.8% on average. And then you subtract from that the change in velocity. And velocity, circulation, that's the GDP over the money supply. That's been declining at about 2.5%. So if you add those things all together, you get 6.3% is the golden growth rate. So let's just say roughly, using the last 10 years of data, it's more or less 6.5% is the golden growth rate for the money supply measured broadly by M4. And what we have is 24%. Well, there's a huge gap, and that suggests that there's going to be a lot of inflation worked into the system. And we're seeing that not only with this consumer price index increase, but if you look at intermediate goods, not final goods and services that are sold and measured in the consumer price index, but the intermediate products that haven't been sold to final consumers yet, raw inputs and so forth, those are going up much more rapidly, almost double the rate of the consumer price index. So all that's coming in the system and coming down the pipeline.
People are concerned about the velocity of money. As you can see, it's still low. So how are we going to get 5% inflation with such a low velocity of money?
Oh, inflation, people are very confused about velocity and mixed up about it constantly. The velocity of money trends down in a secular trend as economies develop, and now the trend in velocity is about a negative 2.5% in the United States over a long period of time. And if there are any deviations from that trend rate of decline of 2.5%, those deviations revert back to the trend fairly rapidly after they occur. So that will happen. Velocity will pick up and go back up to the trend rate, which actually is a negative trend rate of about 2.5%, and bang, there you are. You got a lot of inflation.
Okay. Professor Hanke, what will the Fed do now that we have 4.2% annual CPI? It's far above their 2% target. What are the tools they're going to enact? Will they do anything? Will they just leave it alone because Jerome Powell says it's transitory?
I think the Fed's position is that this is a drop in the bucket, a transitory thing. We don't have to worry about it. The Fed's obsessed with trying to influence our perception of inflation and all these things, and they will ignore it. They will continue to ignore it until next month it's up over 4%, and the next month, and that starts going higher and higher. And once you get over about 5%, they'll pivot and change their tune and start tightening up on the money supply. And when they do that, of course, then all hell will break out in the financial markets, and particularly the stock market. We'll see these high multiples that we're witnessing right now in the stock market come off. But that's quite a ways down the road. I don't think the Fed will make much of a change in things for quite some time. You have to remember that Jerome Powell, the chairman of the Fed, is up for reappointment next year. So he's going to want to keep goosing the money supplies and make President Biden and the modern monetary theorists all happy. You see, the modern monetary theorists, of course, they look at all this and they say the money supply growth doesn't make any difference. It doesn't really influence inflation. They're like Powell,
right?
And like the president, they want to put blinders on and ignore this. But
yeah, we're going to talk about
it's not going to go away, and they will eventually have to deal with it.
We're going to talk about Biden in just a minute. You're aware of this, of course, $1.7 trillion deficit the most on record for the first half of the year. Professor Hanke, what is a bigger driver of inflation right now? Fiscal stimulus, which is what this headline is referring to, or monetary stimulus, which is what the Fed has been doing?
Oh, it's monetary, but the fiscal spending and the deficit of 1.7, that puts us at, it's around 10% of GDP, the deficit, you see it's running.
Yeah.
And that's all being monetized by the Fed. The Fed has been buying the bonds that have been issued by the federal government. And when they do that and they goose the money supply, that's why the money supply is growing at 24% per annum, because they've monetized all the debt that's being issued by the federal government. And so it's the money supply that matters.
Right.
If they weren't monetizing that debt, what would happen? They'd be selling that debt to the public, the government would, and that would be squeezing out private sector activity, and you wouldn't be monetizing it, and we wouldn't have these high monetary growth numbers, and we wouldn't have 4.2% inflation staring us in the face. So, and to get a handle on on this, think of Japan.
Mm-hmm.
Japan has been running huge deficits and has the highest debt to GDP ratio of any advanced country in the world right now.
Yeah.
And they've had zero inflation for the last 20 years.
Why is that?
No monetary growth. They haven't been monetizing all this deficit. So they have a huge fiscal deficit, and fiscalists would say, oh, gee, that should give us a lot of inflation.
Right.
It's given no inflation, zero inflation in Japan, because the money supply, broadly measured, has been growing at a very anemic rate. Look at the United States in the 1990s, the tightest fiscal policy we've endured, or I should say enjoyed under tight fiscalist Bill Clinton. And we had, in fact, the last 2 years of Clinton's presidency, the second term, he was running fiscal surpluses, not deficits. And what happened? We were growing very well under Clinton, and we were growing very well because we had accommodative monetary policy during the 1990s. So we had tight fiscal policy, but accommodative monetary policy, and we had good growth and moderate inflation in the 1990s.
So I've talked to several people actually who take the counter argument. One person's explicitly said that our country is being Japanified, meaning we're more likely to see Japan in the 90s as a scenario than Zimbabwe on the other end of the extreme. Another person I've spoken to has said that deflationary fears is more of a concern than inflationary fears. I'm guessing you would disagree with both of these viewpoints then.
Yeah, you have to, because you have to look at the money supply, and that will call a tune. In Japan, the money supply has not grown for 20 or 25 years, and they've had no inflation. In Zimbabwe, at the extreme, the money supply has exploded over the last 10 or 15 years, and they've had 2 hyperinflations, actually, and they're still running at an inflation rate over 200% per annum in Zimbabwe. It's always the money supply. It's the money supply, stupid.
That's a great acronym. Maybe we should put that in a T-shirt.
I think we could.
We should. I think it would sell well. Add to the inflationary environment we have today. I want to close on a comment you made earlier. You said that this inflationary growth past 4% is going to put an end to Biden's triumphant march. Can you elaborate on that statement? What does inflation have anything to do with Biden's policies? What's the connection there?
Well, people don't like inflation in general, and if it gets up over 5%, and the Fed is forced then to tighten up, which they will do, that will knock the stock market for a loop, and all those things are bad. And it's going to come back to haunt Biden, because he's on his triumphal march right now, spending like a drunken sailor, convinced Powell to open the monetary spigots at full blast and have monetary growth at 24% per annum, fiscal deficits at 10% of GDP, and Biden's telling us, don't worry about anything. Everything's great. Everything's a free lunch. Everybody's getting a free lunch. Well, under the scenario of 5% inflation and ultimately the Fed tightening up and the stock market taking a nosedive, believe me, everyone's not going to have a smile on their face when they see President Biden triumphantly marching down the aisle.
Okay, we're going to follow up on that stock market taking a nosedive when it happens, Steve. Harbinger of things to come. None of these things sound great, but we'll watch out for that. Thank you for that very important message. Thank you for coming back on today.
Thank you, David.
And stay tuned for more on Kitco. I'm David Lin. If you're watching on YouTube, don't forget to subscribe.